Hey there, I am Christian Reither of Curreen Capital, and today I wanted to talk about investing in illiquid securities, the opportunities as well as the risks. And if you stick around at the end, I'm going to talk a little bit about some of the risks if you're looking at funds that invest in illiquid securities, but that's the bonus at the end. So first, let's talk about illiquid securities and what I mean by that. An illiquid security is a position that you could not get out of completely on a day of your choosing without moving the security price by more than 1%. So part of that is just the security itself, where a small security might be illiquid for everyone on Earth just because it doesn't trade every day or it trades every few weeks or even every few months. That's illiquid for everyone on Earth. Then there are securities that are illiquid based on your personal circumstances. If you're Berkshire Hathaway and you need to put $100 billion into any idea, most securities on Earth are, by definition, our definition, illiquid. So part of it is the security itself, part of it is your position, and part of it will change over time as the company matures or changes, goes dark, what have you. So the company itself will change, your circumstances will change, and the times that you're investing in, they will also change. During a crisis, a lot of securities that used to be liquid tend to stop being liquid, and that can be a problem for you. But that's what we mean by an illiquid security. The reasons that you'll see on the internet, on Finance Twitter, or on other YouTube videos, or where have you, the reasons for investing in illiquid securities are a few. So first off, there are going to be investors who have rules against investing in illiquid securities at all, and so these people, just by basis of their rules, will never even be looking at these securities. So you've got less demand for them. You can go in, scoop them up. Nobody else is even going to buy them, not because they didn't look at them, but because they're not even allowed to touch them. So that's one good reason. Then you've got other investors who might be very smart, like Berkshire Hathaway, but they just can't invest in illiquid securities because those securities are too small to move the needle or too difficult. They're smart, but they can't invest in these things. So you, as an intelligent investor, can go in and get them. The rules-following investors won't get them, and the bigger, smart investors won't get them, so you can get them. And so you might be able to get these gems of businesses that other people just can't invest in for no good reason, aside from their size or their silly rules. So that, I think, is a compelling, emotional idea of being able to take advantage of your size, your nimbleness, and take advantage of the silly rules or circumstances that other investors find themselves in. So that tends to be something attractive for people. Another reason to invest in illiquid securities is to be able to take advantage of their very illiquidity. So because they don't trade very much, because they're hard to get out of, you might have days or situations where an investor needs to get out of the stock, almost regardless of price, and you can come in and relieve them of that burden and say, yes, I will take those shares of that stock or this security off of your hands, but it's going to be at a lower price. So then you come in, get the stock at a low price, and you're able to take advantage of that illiquidity. So those are some of the reasons to invest in illiquid securities, and some of the reasons why I historically have been partial to the arguments for investing in illiquid securities. I'm attracted to this. I like to be nimble. I like to be able to take advantage of other people's foolish rules. All of this has worked for me. But as my fund has gotten bigger and I've put more of what I'd say illiquid securities into the fund, I've started to notice some of the downsides. So right now, out of the 8 positions that we have, 5 of them fit my definition of illiquid securities. 3 of them, it would take days or even weeks to sell out of. The other 2, there are definitely days where we could sell completely if we wanted to, but there are other days where it would take a while. So 5 out of my 8, maybe a little bit over 50% of the portfolio is in these illiquid securities, and I've started to notice, some of the downsides, some of the risks that are inherent in illiquid securities that you might not have thought of, or that don't really come up until you start getting a little bit bigger. So one of the things that you hear about with illiquid securities is that you are sort of longer term relationship with these things. Because the security doesn't trade very often, you have to consider it more of a marriage. So the argument is like, it needs to be a very good business because you're married to it, or it needs to be a very good, very attractive security or opportunity because you're in there for a long time. And people a little bit brush this off as saying, you gotta be good, you gotta know what you're doing, you gotta know what you're buying, so shame on you if you buy something bad. It was your mistake, it's not the fault of the illiquid security. Which I get. Also that as you buy something that's good, over time it becomes more known, it becomes more liquid, so as long as you buy it right, the illiquidity issues go away. Some of the other risks that I've been aware of with illiquid securities is the fact that it's illiquid means that it could be you who's having the need to get out of these stocks. It could be you who needs cash. And all of a sudden, instead of being the person who comes in to relieve someone of their burden, it could be your burden. And it could be somebody else who's coming in to relieve you of that. So you could have a personal emergency that requires you to get cash, or you could have, if you have a fund, you could have redemptions that require you to sell whatever you can sell. And so you're forced to sell these illiquid securities at prices that you would not want to, just because everybody has bad days. And so that illiquidity premium that you got on some other day, but for the grace of God, there go I, like someday that might be you going there. So you need to handle your affairs so that you can handle bad days, so that you won't be the one selling, you won't be the one providing that illiquidity premium to somebody else. What's become more apparent to me lately is that the risk with illiquid securities is that you need cash. And sometimes you need cash because it's a bad day, but sometimes you need cash because it's a day full of opportunity. So the upside view of, hey, you find a once in a lifetime or once in a decade opportunity and you want to put cash into it now. It could be another illiquid security where somebody wants to get out really bad and you can buy it at a super attractive price, or it could just be a great opportunity that comes up and you want to buy that, but you realize that your portfolio is full of these illiquid securities, and so either you have to attempt to sell some of these illiquid securities and take whatever haircut you have to take, and it might be impossible even to get out of them, or you're forced to sell your more liquid names, which might not be the ones that you want to sell. Maybe they're very attractive and your illiquid securities are, at a higher price compared to their value, but you just have to sell the liquid names because they're the ones that can give you money. So it could be like a happy day where you've got this great opportunity, but you find that these illiquid securities are holding you back. So as Buffett says, if you're hunting, large, fast-moving elephants, you need to carry a loaded gun. Illiquid securities are bullets that you've put away and you can't use. So that can be a risk that you might not have thought about with these things. Another issue is the more illiquid securities you put into your portfolio, the bigger a portion of the portfolio they become, the more locked in you are. So the first illiquid security you buy, no problem. You can take advantage of whatever opportunities come along the way. The second illiquid opportunity you buy, there might be some rare circumstances under which you'd have trouble buying something amazing or taking advantage of some amazing opportunity. But like once you start getting, 3, 4, 5, so 5 out of my 8, maybe a little bit over 50% of the portfolio is in these illiquid securities, you realize that, hey, maybe too much of my portfolio is locked up in these things, and now I'm no longer as nimble as I want to be. I'm no longer as able to take advantage of opportunities or recover from bad days as you might want to be. There are a couple ways I think that we can deal with this issue of illiquid securities. So one way is you want to raise your standards for illiquid securities. So if it's an illiquid security, because you're basically getting married to this thing, you want to make sure that it's truly an outstanding opportunity. And this is something you want to think of with the first illiquid security, because you put one in and it doesn't really matter. You put a second in it starts to matter. But with that third one, all of a sudden you need to have super high standards, and now that third one might be way better than the first one you bought, but it's hard to get rid of that first one. So you got to start thinking about this sort of before it affects you. So that's one way to do it. One way to think about illiquid securities is to raise your standards for what you're willing to accept. Second way is to start following rules like those crazy institutions and sort of limit how much of the whole portfolio you are willing to put into these illiquid securities. One, to handle adversity, but also two, to be able to take advantage of opportunities. Because again, on a good day, if you wanted to, you couldn't even use margin debt to buy that new great opportunity because your illiquid securities probably won't be acceptable for margin. And even if they are, now you're running a big risk because you can move the stock prices or the security prices of those with relatively small amounts of money, and that could get you into margin call. All sorts of problems ensue. So you could try to avert this by limiting the amount of illiquid securities that you have to X% of your portfolio. Hey, my camera turned off before I could tell you that another way to avoid this problem is to hold cash. Then no matter how many illiquid securities you have in the portfolio, you can handle adversity or opportunity with that cash that you have sitting on hand. So, back to the show. So if you want to go after them, you want to be thinking of how you handle those days when you need cash, both the bad days and the good days. And I hope that some of the ideas I have gave you some ideas on that. Thanks for watching, everybody. I hope you enjoyed this video. I try to put things out there that aren't the 101 level basics that you find everywhere else. What I want to provide is a graduate level or even postgraduate level investing information and ideas, because there are some of these topics out there that I don't think are addressed properly or as deeply as you deserve. So if you like these types of videos, hit that like button, hit that subscribe button, and I'll see you later. Alright, thanks for sticking around for the bonus. I want to tell you about a risk that you might not have thought about if you are looking at or are already invested in funds that invest in illiquid securities. So one thing that I noticed when I was buying a particularly illiquid security was how easy it was to move the stock price, even unintentionally, of those illiquid securities just by buying it myself. So with a few $100s, I could move the stock price if I wasn't careful. And even when I was careful, I ended up moving the stock price. I had a situation where I was buying, the stock price went up. It made me mad that, you know, all the other buyers were like bid jumping and all this stuff, and it made me mad that we were all, you know, not acting properly and just keeping the stock price low and buying it. And so I decided to stop buying and see what happened. And lo and behold, the stock price fell. So even though I had been buying smart and carefully, I had actually been boosting the stock price without my knowing it. And this made me realize that, like, you can move the prices of these illiquid securities much more easily than you might think. So you might have a fund manager who is inadvertently moving the stock prices of the fund, of the positions that they own. And this can create a problem or a situation for the fund that you might not think about. So if a fund buys an illiquid security and makes it a decent sized portion of the fund, now you've got, you know, hundreds of thousands or even millions of dollars in a position, and that position can be moved by very small amounts of cash flowing into that stock. So this fund manager might have driven up the stock price of that position, of that illiquid position, just by buying it themselves. That might in turn create good performance statistics for that fund because, you know, they've got this position and the position is moved up, and so the fund has done well. That might lead to inflows. And where are those inflows going to go? Well, some of them might go into that illiquid security or into another illiquid security, and you can get that same feedback loop of cash flows in, the stock price goes up, that drives performance, and you get nice performance statistics. So more money comes into the fund, and again, you get this vicious or virtuous cycle depending on how you're looking at it. The problem is, or one of the problems is, that this cycle is dependent on new money flowing into the fund. It might be related to fundamentals, and it might be divorced from the fundamentals of those securities themselves. And it might be the case that if money stops flowing in, if the fund manager then stops buying these positions, the stocks might start to fall, which could create poor performance, which could lead to redemptions or the fear of redemptions. And you might get sort of a run on the bank where the performance is weak, redemptions happen, fund manager has to sell stock, which is of this illiquid stuff, which drives worse performance, and so on. You get this vicious cycle instead of the virtuous cycle, depending on your perspective, that you saw before. Another problem can be because it is so easy to move those stock prices with small amounts of money, the fund manager might be tempted and might succumb to the temptation of supporting the stock prices of these things, because with a few hundred or even a few, maybe a few $1,000s, you can support a position which might be millions of dollars just because these things don't trade. So you put in a bid or you even buy stock supporting it, and you can justify it in all sorts of ways of value or blah, 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 like crazy people are selling. But you have a fund manager who might be tempted to protect their stocks, protect their performance so they don't get that bank run, so they don't get that vicious cycle. But again, that creates its own problems. So be careful, be aware if you're invested in funds that invest in illiquid securities. Strange things can happen with performance, and all might not be quite as it seems. So in particular, look at the trading activity on the last day of reporting periods for the large portfolio positions that are illiquid. You want to make sure that the fund manager or somebody isn't doing something crazy on those days that might impact performance temporarily, or support a stock that doesn't need to be supported. Anyway, buyer beware, and hopefully you're aware now of something that you might not have thought of with illiquid securities in funds. Thanks again. Bye-bye.